Imagine you worked for 30 years. You did everything right. You saved. You were careful. You did not spend money on things you did not need. And at the end of those 30 years, you open your account, and the number is there. It is exactly what you remember saving. But somehow, you can buy less with it than you could have 20 years ago. The number did not change. The world did. Nobody stole from you. Nobody called. Nobody sent a letter. There was no announcement, no vote, no press conference where someone said, by the way, your savings are going to quietly lose about 30% of their purchasing power over the next 2 decades. It just happened. And here is the thing that should bother you more than the loss itself. This is not a bug. This is not a failure of the system. This is the system working exactly as designed. There's a mechanism. It runs quietly, almost invisibly in the background of every economy on Earth, and it makes a decision every single year about what your money is actually worth. Most people never learn its name. Most people never learn how it works, and most people, by the time they notice it, have already been paying its price for decades. Today, we are going to change that. Part 1. The question nobody asks. Let us start with something most people have never actually stopped to think about. What is money exactly? Not the philosophy of it, not the history, just the practical question. What is the $20 bill in your wallet actually doing? If you think about it for even a moment, you realize money is not valuable in itself. The paper is worth nothing. The number in a banking app is just a number. Money is valuable because of what you can exchange it for. It is a ticket, a claim on goods and services in the real world. Now here's the question nobody asks. Who decides how much that ticket is worth? Not the face value, not the number printed on it, the actual purchasing power, the number of real things you can get in exchange for it. Most people assume the market figures it out, supply and demand, competition, the invisible hand, all of that, and there is some truth to that, but it's not the whole truth, because underneath all of it, there is a target, a deliberate government-approved target for how fast your money loses its value every year. That target is called inflation, and the mechanism that sets it, enforces it, and keeps it ticking is called monetary policy. Specifically, it runs through one institution in almost every major economy on Earth, the central bank. In the United States, that's the Federal Reserve. In Europe, the European Central Bank. In the UK, the Bank of England. The names change. The mechanism is almost identical everywhere. And this mechanism, right now, today, is targeting 2% inflation per year. 2%. Sounds small. Sounds almost harmless. We'll come back to that number. Part 2. How the mechanism actually works. Before we talk about what this mechanism does to your savings, we need to understand how it actually works. And the honest answer is, it's both simpler and stranger than most people expect. Central banks do not control your salary. They don't set prices at the grocery store. They don't tell companies what to charge for products. What they control is the cost of money itself. Think about what it means to borrow money. When a bank lends you money, it charges you interest. That interest rate is essentially the price of borrowing, and the central bank sets a target for the most fundamental interest rate in the economy, the rate at which banks borrow from each other overnight. This rate is called, in the US, the federal funds rate. When this number goes up, borrowing across the entire economy becomes more expensive. Mortgages, car loans, business credit lines, all of it gets pricier. People borrow less, they spend less. Demand for goods and services falls. Prices stop rising as fast. Inflation cools. When this number goes down, the opposite happens. Borrowing becomes cheap. People and businesses take on more debt. Spending increases. More money chases the same amount of goods. Prices start rising. Inflation picks up. That's the lever. One interest rate, adjusted by a committee of economists and bankers, ripples out through the entire economy and eventually touches every price of everything you buy. Now, here's where it gets interesting. Central banks don't just react to inflation after it happens. They try to target it in advance. The Federal Reserve, for example, has an explicit inflation target of 2% per year. That's not a ceiling. It's not a worst-case scenario. It's the goal, the destination they are actively steering towards. which means, by design, by policy, by deliberate intent, your money's purchasing power is supposed to fall by 2% every year. Every single year. Not because of accidents, not because of mismanagement, not because of war or drought or any external shock. Under normal, functioning, successful conditions, the plan is for your money to slowly and continuously be a little bit less worth. The question worth asking is why? Why would anyone design a system that does this on purpose? Part 3. The uncomfortable math. Before the why, let's talk about the math, because 2% sounds like nothing, and over 1 year it nearly is. If you have $10,000 sitting in a savings account and inflation runs at 2% this year, you effectively lost $200 of purchasing power. Not from your account still says $10,000, but the things you could buy with it went up in price. The loss is invisible, the money is still there, the value is not. Over 10 years at 2%, that $10,000 loses roughly 18% of its value. Over 20 years, it loses about 33%. Over 30 years, the length of a typical career, it loses roughly 45%. Almost half. Gone. From a policy target, from a decision made by a committee in a building you've never been inside. Now, add one more thing. 2% is the target, not the actual. The actual rate of inflation in the United States averaged closer to 3.5% from the 1980s through the 2020s. In 2021 and 2022, it hit 8%. In some categories like housing, healthcare, and education, the sustained rate over the past 40 years has been dramatically higher than the theoretical model suggests, which means the real loss is considerably worse than the theoretical model suggests. And here is the part that tends to make people uncomfortable when they first hear it. While your savings are losing value, the people who own assets, real estate, stocks, commodities, businesses, the things that prices are rising around, they're keeping pace or pulling ahead. Their net worth moves with inflation or above it. Yours, if it's sitting in cash, does not. This is not a conspiracy, it's not secret, it's a structural feature of how the monetary system distributes the cost of inflation. The people with capital bear it less, the people with savings, particularly cash savings, bear it more. So, the obvious question is still on the table. Why is this the design? Part 4. Why they designed it this way. Here's the official answer, and it's not nothing. Inflation, at low and stable levels, is considered necessary for a modern functioning economy. Here's the core logic. If prices are falling, or even if people expect prices to fall, they delay purchases. Why buy a refrigerator today if it will be 10% cheaper next year? Why invest in a factory if the products it makes will be worth less by the time you sell them? Deflation, falling prices, can trigger a spiral of inaction that collapses economic activity. Japan lived through exactly this in the 1990s and spent 2 decades trying to crawl out of it. Inflation, at low and stable levels, keeps money moving. It creates a gentle pressure, a mild cost to holding cash and doing nothing with it. It encourages investment, lending, hiring, production. The economy runs on circulation, and a small, steady inflation rate acts like a lubricant. There's also a debt dimension. Most modern governments carry large amounts of debt. Inflation erodes the real value of that debt over time. A government that borrows $1 trillion today is in 20 years of 2% inflation, paying it back in dollars that are worth roughly 40% less. In effect, inflation is a slow, quiet mechanism for reducing the real burden of sovereign debt without ever technically defaulting. Politicians love this because they never have to say the word default. And there's a labor argument. Cutting nominal wages, actually reducing the number on your paycheck, causes enormous social friction. People hate it, companies resist it. But if wages stay flat and prices rise, the real wage, the purchasing power, falls quietly. Employers can adjust labor costs without the political and psychological backlash of a formal pay cut. Economists call this the grease in the wheels of the labor market. These arguments have real merit. Economists have studied this for a century. The logic holds under many conditions, but the logic also has a flip side that rarely gets airtime. Part 5.
what the official story leaves out. The system was designed to balance a set of competing interests, and over time, the balance has shifted in ways that the original designers may not have anticipated or may not have cared about. Consider the 2% target. It wasn't derived from first principles. It wasn't the result of some mathematical proof that 2 is the correct number. It came partly from a policy decision made in New Zealand in 1989, adopted informally, spread internationally, and eventually became the global consensus almost by accident. The Bank of England adopted it in 1992. The Federal Reserve formally adopted it in 2012. For most of its existence, the 2% target was an informal aspiration, not a legal mandate. Consider also who this system protects and who it does not. When the Federal Reserve cuts interest rates aggressively, as it did after 2008 and again